Hey everyone, Kieran King here. Just a few days ago, Deliveroo listed on the London Stock Exchange in the UK, but was quickly labelled the worst IPO in London's history by one of its bankers as shares fell almost 26% in one day. Who is Deliveroo? Why did they decide to list? Why the catastrophic decrease in price? And what's next for the company? Let's dive in. Deliveroo was founded in 2013, by a guy named William Shu as an online food delivery company. You may have seen the company in a city near you with delivery riders zipping around the streets flashing their iconic blue delivery cases. It has grown quickly over recent years and is backed by some of the biggest names such as Amazon, Fidelity, Index Ventures and others. How do they make money? What is their business model? Restaurants and takeaways sign up to their app and they list their menus and customers order through the app, and Deliveroo fulfills the delivery side of things, and they take approximately 25 to 40% commission of every transaction that goes through the app. In 2020, the company generated revenues of circa £1.2 billion. Which is a lot. However, after paying their gig economy delivery riders, payment costs, tech platform fees, and so on, it doesn't leave them with much margin. In fact, they are still not profitable. And 2020 actually showed a loss of around 224 million. Not only that, it is a really competitive landscape with the likes of Uber and Just Eat doing similar things. So in order to rocket their growth and compete with the big boys, they decided to do an IPO, which is an initial public offering. This is where they issue new shares to the general public, raising a ton of cash in doing so, but also allowing the earlier investors and founders to realize some liquidity in the business. Now, who's involved in this transaction? Well, the main leaders for the transaction were Goldman Sachs and JP Morgan, but there were also some junior parties involved, such as Bank of America, Citigroup, Jefferies, and Numis. Now, one of the main jobs that this group has to get right is making sure that the listing price is correct. They do this by saying to Deliveroo, basically, what do you want to sell shares at? And then they go to a bunch of investors and ask, well, what do you want to buy shares at? And they come to some sort of conclusion in that. And that bit is absolutely critical, and we're going to come back to this a bit later. On Wednesday, the 31st of March 2021, they IPO'd on the London Stock Exchange. Now, let's look at some metrics here. The IPO price that investors bought shares at was essentially 390p a share, £3.90. However, they actually opened at a price lower than that, at 330p a share. And at the end of the trading day, the company saw their shares close at 287p a share. Now, this is a massive 26% drop in the share price in one day. And if you were an investor investing at 390p, your shares would only be worth 287p now. So this says to me that the stock was overvalued and the market just readjusted to a more natural price. In other words, these guys here got the price wrong. But let's look at why. Why was the price wrong? There's a few reasons for this. And first, I would say, is due to the company's dual class share structure. This is common in some US Silicon Valley firms, but not so much here in the UK. Effectively, this structure means that the founder, in this case Mr. Shu, has a different class of shares to other investors, giving him basically 20 times voting rights than the rest. That means, hypothetically speaking, if William Shu owned 1% of the company and I owned 19% of the company, Will Shu has more voting power than me. And this is not exactly an attractive scenario for investors. And I feel like this may have not been taken into account when setting the price. Number two, there has been questions recently around the firm's ESG, or environmental, social and corporate governance. Now, there's been a lot of noise around gig economy type apps such as Uber and the rights they afford their workers. Deliveroo has been targeted for poor working conditions, lower than usual rate wages, no workers' rights, etc. It faces legal challenges in 5 of the countries it operates in on this. This for me is also a factor in discouraging large investors from taking part in the listing, as a good ESG policy is becoming more and more significant these days. What else? Timing. The company chose to list at the end of Q1 2021. Okay, this is when many fund managers are preoccupied getting out quarterly reports, rebalancing portfolios, and many actually don't take new positions at this time. So this could have affected the take up and the price. What else? Retail investors. Deliveroo offered shares in its IPO to its actual customers, okay, people that use the app, to the tune of about £50 million. And thousands of people invested anything from, say, £250 to £1,000 each through a platform called Primary Bid. Now, why did they do this? They probably did this to drive hype around the IPO and inflate the price, but this can create problems. Retail investors are given a price, and that's that. Remember what I said before about finding the middle ground between what price Deliveroo wants and what price the buyers want. Retail investors are generally not as clued up as the major investment funds or institutions, and this undermines this process entirely. The final point I've come across in my reading is essentially the wrong multiple being used when working out its valuation. Okay, but what do I mean by this? We said that Deliveroo had revenues of about 1.2 billion in 2020. Okay, however, their opening listing valuation was 7.6 billion, and that's roughly 6.3 times that. Other multiples for similar delivery companies, such as Just Eat, has worked on a lower multiple. I think Just Eat worked on a multiple of 5.8 times their revenue. However, there have been companies such as DoorDash in the US that has based its valuation on a lot higher multiples. So this potentially could be a small but interesting point. So those are some of the reasons why it didn't go as smoothly as planned. And what's next for the food delivery company? Well, they don't have to go ahead with the listing. They can in fact cancel it by the 7th of April. However, that would cause some significant PR damage, I suspect, if they do that. These things happen, and companies can and do recover. Facebook got off to a rocky start, so did Ocado, but you wouldn't think that now based on their performance. So it's probably a question of the stock readjusting itself to a happy equilibrium. Yes, investors will have gotten a bit burnt, but pricing mistakes like this can be learnt from. What do you think? Please post your comments or thoughts below. That's it from me. I hope you enjoyed the video. If you did, please smash that like and subscribe button. Until next time, take care.